as a buyer who is privy to all this data and can interpretate it correctly and without being biased or influenced by these headlines, you've got a chance here to go out, find a home you like, and negotiate some concessions to get your financing terms to be very favorable so you can get into the homeownership situation, see some appreciation of that home value over the next couple of years. And then when rates do fall more substantially, then you can refinance that mortgage and get a lower, note rate on that mortgage long term. Again, goes back to that concept. Um, Date the rate, marry the home. These conditions, I think, could not be better for that purpose. And again, for a refinance for a homeowner, the refinance idea is not as bad as it seems. As I explained earlier, you have some cases now where folks are deciding we're not going to sell. We'd like to, have maybe a nicer home, a bigger home, some better amenities. They're realizing that in the scheme of things, you might be better off if you don't want to sell, because again, there are a lot more sellers now. There's a lot more inventory. If you don't want to join that crowd, but you want to, change your home ownership situation in terms of amenities, size, or other factors, then a refinance isn't as unattractive as you might think it otherwise would be. So I'm starting to do more of those kinds of situations where we're going and doing a refinance, pulling a lot of cash out, and in some cases giving up that low rate mortgage because of wanting to improve the home they have and decide to stay there long term. So you want to kind of keep that in consideration if you're a homeowner. And of course, the other aspect of that is you decide to keep your home and you don't want to give up that 2.5–3% mortgage, but you got so much equity. These equity loans are a very good option. I think we talked last week about how in some cases I can arrange an equity loan, a fixed rate, traditional fixed rate, fixed term second mortgage. If you need to do some of those improvements, new kitchen, new backyard, add a room, add an ADU. I've got one case where we did a substantial fixed rate, fixed term second for the homeowner to prepay the college tuition for their son for 4 years. Those kind of scenarios are perfect for an equity loan where I can actually get you a fixed rate, fixed term loan under 7%. I mean, that is a very, very good deal for an equity loan. Second mortgages will always have a higher rate than first mortgages, but to consider the idea that you can get a fixed rate second under 7%, that's phenomenal. And when you combine that with maybe your existing 2.5% first, your blended rate, when you consider the two loans combined together, you've got some pretty cheap financing there to allow you, on the one hand, keep your home, but on the other hand, be able to get that cash to do some things with either that home or for other major expenditures, so that overall that cost of financing is actually very reasonable.